buyer beware, how thousands of investors are being sold overpriced property, and the mortgage debt time bomb, tightening lending standards as Sydney and Melbourne prices slide. Australia's red-hot property boom began to run out of steam in 2018 as prices cooled. Property developers left holding off-the-plan apartments were targeting buyers with the help of the wealth industry. Thousands of investors were being lured into buying overpriced properties, with some financial planners, mortgage brokers and accountants receiving large commissions as a result. As this report from Michael Yander shows, it was very much a case of buyer beware, with property investments largely exempt from regulation.
Australia's just gone through its biggest residential building boom in history, and everybody's looking to cash in.
It's all attractive and unregulated, and it's too good to be true in most instances.
It's not just developers, real estate agents and mortgage lenders profiting.
We've got people that have put a lot of trust in their accountant, the mortgage broker, in the financial planner. And they are steering them towards property that, quite frankly, a lot of the local agents wouldn't even touch or don't want to sell.
There's big money on offer for flogging off-the-plan apartments that developers are struggling to sell.
Our standard fee is 1.7% commission for a sale across the board. But there's the marketing companies getting upwards of 8%, 10%, even 15% in some cases.
These are just a few of the many offers that one financial planner we spoke to has been bombarded with. It's perfectly legal for real estate marketers to make these offers, but it may be illegal, and it's certainly unethical for financial planners to accept them.
When they're operating as a financial planner, no commissions and real estate has to fit within the best interest duty. But for non-financial planners who aren't operating under those licenses, those same rules don't apply.
Because real estate isn't considered a financial product, it's not illegal for someone unqualified to give advice about investing in it directly. One of the nation's largest mortgage broker networks is among those involved. The ABC's been told that mortgage choice brokers can earn thousands of dollars for referring a client to property investment firm Blue Wealth. Blue Wealth sells investment properties on behalf of developers. Both companies declined to comment on their commercial arrangements, but Blue Wealth said it is licensed to operate and puts client interests first. Not all brokers want to cash in.
Logic tells me that people would be tempted by. Most brokers I speak to don't want to go near it.
Bruce Carr's a mortgage broker who's seen firsthand the fallout when people are sold off-the-plan investment properties they can't afford.
Didn't own her own home. She was renting. She had $30,000 in unsecured debt. And she'd been advised to invest through a self-managed super fund in an investment property. My first instinct was to try and help her pick up the pieces, but I ultimately decided that in spite of the pain, the loan was not in her best interests.
Real estate agents say off-the-plan properties sold by these marketing or property investment firms are often massively overpriced.
Those larger fees are on the basis that you get higher prices.
A lot higher.
I've said to them, I'm quite happy to sell for you, but at the moment we're $100,000, $150,000 overpriced. Their comeback's always been, we can't reduce the price because this financial institution is selling them through the self-managed super funds, and we can't have two-tiered marketing.
Agents say the best way to avoid being ripped off is to do your own research about prices and rents.
And this is really aimed at, I suppose, the new investor or the lazy investor who really doesn't want to go out and do their own due diligence.
Edwin Almeida's calling for mandatory disclosure of all sales commissions and marketing fees as part of real estate contracts.
I'm acting for the vendor. It's just that's who's paying my bill.
So if an advisor or broker tries to sell you a property investment, it's worth asking who's paying theirs.
Michael Yander there. By the middle of the year, the retreat of investors from the property market was starting to look like a rout. Official figures showed investor loans plunged in March, while owner-occupier interest was also cooling. Regulators had been ratcheting up lending standards and banks were tightening access to credit on the back of the Banking Royal Commission. It meant borrowers were facing a credit squeeze, which also increased the risks for a faltering property market. Here's finance correspondent Philip Lasker.
19 straight board meetings without a change to rates, but the RBA governor insists he's been busy.
I sometimes read in the press that the board's job has become very easy. We just meet and we do nothing. No doubt the board members here tonight will tell you a different story.
That's because the RBA has had to find another way to balance the conflicting forces of boosting a sluggish economy while taming runaway property prices. Interest rates have been kept at emergency levels to support growth as regulators take aim at the property market by tightening lending standards.
Lending standards were too loose. If we think of what APRA and the RBA are trying to do with the Council of Financial Regulators, they're trying to put their foot on the credit fire hose, if you think of it in that terms. And so trying to put a squeeze on credit going into the housing market and household sector and try to ease things more gently.
And so far, it's working.
The housing market's clearly responding to tighter credit conditions. You probably could describe this as a credit crunch or a credit squeeze, although we are still seeing owner-occupiers not largely affected by the tighter credit conditions. This is really about tighter credit conditions for investors, which is why we're seeing this flowing through to Sydney and Melbourne much more than other markets.
There's a close relationship between the supply of credit to investors and house prices. Prices started coming off almost as soon as the banking regulator, APRA, introduced speed limits on the amount of lending for investment. Then, as credit growth bottomed out, prices started to recover. But the Banking Royal Commission could well mean the squeeze will become more intense.
It's also possible that lending standards in Australia will be tightened further in the context of the current high level of public scrutiny on the banking industry. So we're going to continue to watch these issues very carefully.
Because while the Royal Commission will result in much-needed changes, it also risks undermining one of the economy's key growth platforms, a property sector bloated by households with a lot of debt.
So there is the risk that we end up with a credit crunch, which economists would typically associate with the recession. That there's too fast an adjustment that comes through a change in lending standards, or the global capital markets stop funding a country or a banking system.
I think as we move through the Royal Commission on banking, the risk environment for housing is probably heightened, but I wouldn't say it's been heightened significantly.
It looks like this will become an increasingly rare experience, and it's extremely difficult to determine how the engineered credit squeeze will play out and whether it threatens the broader economy.
It's again coming back to the lack of information as to what lending standards really are behind the counter when you go into the bank or the mortgage broker and you find out that a given borrower can borrow 10 times their income. These things are very hard to measure through time.
Now it's assumed the loan assessment process will be done properly. A return to prudence. That's going to hurt.
Philip Lasker there. By May, big city house price forecasts slammed into reverse, with Sydney and Melbourne leading the downturn. It came as regulators continued to tighten the screws on interest-only loans, with $500 billion worth due to expire over the next 4 years. And that raised fears of a sharp sell-off, as many borrowers suddenly faced a 30 to 40% increase in their repayments. Here's Carrington Clark.
Sydney property prices have boomed, up 26% in 3 years. The median price is now around $1.2 million.
Where do we go from here? It's your turn, sir.
But things are changing, and homeowners are starting to feel the financial pinch.
A lot of people are getting to the end of the interest-only portion and being asked to pay principal, and they're finding it quite a struggle. They just haven't really budgeted it in.
Banking regulators have clamped down on interest-only loans, worried it was a risk to financial stability. Banks are now forcing more people to start to pay back the principal on their loan. Nearly $500 billion worth of interest-only loans will expire over the next 4 years. That's 30% of all mortgages. By the RBA's reckoning, a typical interest-only loan of $400,000 will see repayments rise $583 per month when they have to start paying off the principal. SQM research says tighter lending standards are hurting prices, and it's downgraded predictions for house price rises this year.
People who are under stress, looking to sell, will have to just meet the market. And so I think you'll see this persistent grind lower in house prices over the next couple of years.
The Royal Commission could make it even harder for people to get loans.
It's also possible that lending standards in Australia will be tightened further in the context of the current high level of public scrutiny on the banking industry.
Carrington Clark there. It wasn't that long ago the skies in some of our biggest capitals were full of cranes, building an endless array of high-rise apartment blocks. But as Australia posted record months of unit construction slowdown, there was no denying the housing boom was on the slide, and that forced property developers to reassess their projects, as Rachel Papazzoni reported.
These are the Twin Towers of Aura. It's one of the 4 phases of the master plan community named The Retreat, being built in Sydney's Olympic Park. The ambitious 1,000-plus apartment project is one of property mogul Harry Triguboff's latest developments under his Meriton brand. It's a brand that's left a 75,000 apartment-sized footprint throughout Sydney, Brisbane and the Gold Coast during Meriton's 50-year history. But after years of rapid growth, the apartment construction market is heading south.
There's a trend that we're seeing, that there's been a slowdown in apartment construction. Is Meriton experiencing that?
I'm experiencing more than anyone. I build the most.
At the peak of the apartment construction boom 2 years ago, 70,000 high-density apartments were built around Australia in a 12-month period. But a leading economic forecaster says those days are over.
In the last financial year, we estimate that it was probably closer to about 50 to 60,000. And in 2 years' time, we think it'll probably fall to 30,000.
Yeah, so what we've seen, and CBRE obviously acknowledged it.
Global real estate firm CBRE is selling apartments off the plan for 300 developments around Australia. It says the problem is widespread.
Yeah, there's been a lot of adjustments. Developers are stalling projects, their next stages aren't coming on, and smart developers, seasoned developers, are really looking at their offering and what purchasers want.
Developers need to secure a significant number of pre-sales to fund their projects, and tighter lending conditions for investors, like bigger deposit requirements, mean they're struggling to lock in those contracts.
Developers, due to the banking regulations, rely on pre-sales to be able to finance their projects. And being the largest company of pre-selling apartments, we're finding unless you have exceptional attributes, it is very difficult to get those pre-sales of hundreds of apartments that are required to get the developments.
While economic forecasters tip a halving in construction by 2020, the hard numbers are already proving the slowdown. The Australian Industry Group's July Performance of Construction Index was the slowest month for new orders in more than 2 years, and it was also the sharpest monthly decline for apartment construction work in 5 years. Property advisory firm Charter Keck Kramer agrees we're in the midst of a significant pullback.
We're certainly across the major capital cities seeing, in terms of completions, a potential slowdown beyond 2018, 2019. It's difficult to forecast too far beyond that.
But those in the industry say there is a silver lining. Our population continues to grow, reaching 25 million this month, which means demand for apartments like these isn't going away.